Hello and welcome to this Natixis Research Copper Markets Update call. I'm Dahdah, Senior Commodities Analyst within the research team, specializing in metals and mining. And joining me today is Thomas Hodge, our non-linear or options metals trader based in London, and Priyanka Iyer, Head of Commodity Sales and Structuring in Asia. So we thought we would give you today for 30 minutes a good update on what's happening into the copper market. So back in April on Liberation Day, we saw a big downward move from copper from around $10,000 a ton to 8,500. Much of this came back on the concerns about the impact of the massive tariffs that President Trump and his administration were going to impose on most countries around the world. And after that, we saw copper prices rallying. And interestingly also, although most metals rallied, copper has really outperformed. And this is why we'll be discussing more in depth copper than the other metals. So what's happening right now in copper is the curve is in backwardation. The forward curve is in backwardation, meaning there's a very tight supply right now. So prices are around $10,000 a ton, but the future curves will try and ignore the very end of the curve because it's just not very liquid. But you can see that the prices dropped to around 9,900 for June of next year. So this curve basically again is indicating a very tight supply or a rush in the market, very strong demand and a tight supply in the market. Now, if we try and dig as to what is the reason behind this tightness of supply in the market, those high prices and this backwardation, we look at the COMEX LME spread, and we're seeing prices of around under 3 months of around 1,200. So that is way higher than the price of around $200 or the spread of around $200 to $400 a ton that we were seeing prior in 2024. So that is indicating much stronger demand for copper coming from COMEX, from the US. Digging a little bit into it also, you notice that COMEX inventories are rising rapidly since Liberation Day. At the same time, LME and Shanghai Exchange copper inventories are dropping. So what's happening here is on the back of this, if you want, premium that the US copper is commanding, we are seeing outflows from non-US warehouses potentially heading to the US. So you can see that COMEX inventories are rising. You add them up, LME plus Shanghai Exchange, you end up with around 200,000, which is equal to how much COMEX inventories is currently holding. Now in the US, what's happening is because although President Trump gave an exemption to all metals when it came to tariffs, except for steel and aluminium after Liberation Day, he called for a Section 232 investigation. So trying to look at what's happening into the copper market. And on the back of this, he will make a decision on if he will impose tariffs or not. So there's a big concern in the market, in the US market, that he will impose tariffs on copper. And this is why, ahead of potential tariffs, US traders and importers are buying as much as possible and getting it into the US. So when will we hear back from that Section 232 result? Usually we would expect to hear within, so that they announced it in February, so there's probably 4 months left to which they're supposed to submit their document. There is talk that the potential could be delayed. Usually, I would say the time frame usually is quite strict. Now, so what we're making here is that it's the US that's the main driver, this, if you want, pent-up demand, stockpiling demand from the US, doesn't necessarily mean that demand for end consumer demand in the US is strong, but it just means that probably traders want to benefit or are betting that tariffs will take place. The other important driver behind copper prices is the weaker dollar. So we're seeing a much weaker dollar, with the euro now at 118, if I'm not mistaken, up from around almost parity. So that is really helping demand for copper, making it cheaper for consumers that are non-US denominated. The third point, which I think is underreported in the market, is what is happening in China when it comes to the smelters. So copper TCRCs, which is the cost of refining, which is what smelters charge miners to refine their concentrate. So the miners in South America or whatever will send their concentrate to the smelter in China. They will have to pay treatment charges and refining charges. Now, historically, that have averaged around $70 a ton. As you can see from this chart, the latest official data we have that we can report from Bloomberg is around $20. But actually it's negative from what we hear in the market. And this is quite odd. Now, the reason being is that with the very high costs, with the very high price of gold, this has made the newer copper smelters in China, the more recent ones, and by the way, there's been a 20% expansion in copper smelting capacities in China over the past few years, and we're expecting another 10% this year. They're able to refine the copper concentrate and extract from it the byproduct of gold. So initially, what seems to be a negative margin or loss-making situation ends up a profit-making one, because apparently they're able to extract around $300 per ton of concentrate worth of gold. So that is quite interesting for them, and that could potentially explain up to some extent why Chinese imports are still rising. Now, if we're to look at our outlook right now, where prices currently are, our take is, at least from research, my take is that prices are much higher than where they should be. I see prices potentially reaching 8,900 by the end of this year. The main rationale I have is that much of this demand or prices is being driven right now by this pent-up demand for copper in the US. It's not end consumer demand that is justifying a $10,000 a ton. We're seeing a similar situation to what we saw in aluminium earlier this year, whereby there was a lot of imports into the US, and they eventually dropped to much more normal levels or even lower levels than historic months after the 50% tariff was introduced. So my concern here is that the Trump administration puts the tariffs, or even if it doesn't tariffs, that the party ends when it comes to justifying imports, strong or disproportionate imports into the US, which are double what they are during the month of June and during the month of May. The other point also to mention is more of a macro point. The global economy is kind of like lackluster. We're expecting EU growth to be at around 1.2%, Chinese growth probably around 4%. The whole tariff story, trade war story is dampening consumer and investor sentiment. We should be seeing more of that negative data come out towards August and September. So generally speaking, also when it comes to talk about the Chinese stimulus, potentially saving the day, we shouldn't forget that they've got a big budget deficit of around $350 billion. So we're not expecting a stimulus that would be that strong. That's about it from my research side. I would just point out that it's not to say that it's a collapse. Obviously, it's a 10% drop, but I wouldn't expect to see a complete collapse in copper prices because the energy transition story somewhat remains strong. We shouldn't forget that around 30% of copper demand these days comes from energy transition related demand. Now, there are issues with, for instance, China reaching its 2030 targets when it comes to solar panels. But the big story for copper is not as much solar panel that represent 3%, but it's going to be anything relating to transmission. That's about it from my side. I'll first probably hand over to Thomas, who I have a few questions for on terms of what he's seeing in the market, what are trading houses or traders doing, what is the story also of, well, later you'll touch on it, I'm sure, in terms of LME revising some of its rules. And after that, we'll talk with Priyanka about her view from China, where at the end of the day, 50% of the demand comes from. Thomas, up to you. What can you tell us on what's happening in the backwardation, what's happening in terms and in terms of movements from a trader's perspective? And sorry, please, by the way, don't forget to submit your questions. We'll answer as time goes by.
Sure, thank you very much, Bernard. So yeah, it's been an interesting time in the copper market for sure. We had the huge drop at the beginning of April after Liberation Day, liberation in inverted commas, they seem to be all the vogue at the moment. And we have had some pretty incredible tightness at the front of the curve. Just running through a few numbers of cash to threes, traded out to $379 cash premium. That's a lot. Cash to July, which is an even shorter time spread, traded out to 230. And Tom Next, which is a one-day time spread, actually hit a high of almost $100 a ton at the end of last week. It has now eased slightly, certainly right at the front. There's no Tom Next today because tomorrow is the 4th of July and hence the US holiday. So the Tom Next shorts get a day off. And it did in fact end up going out at a contango yesterday. However, apart from that, it stays quite tight. Cash to threes settled at about $95 a ton yesterday, and it is $95 bid today. So the tightness has not gone away. As you say, probably the overarching reason for that is the draw of metal into the US because there's a Section 232 story, and with that, you know, if that tariff is expected, if it comes in to be about 20%, and we've now got copper at 10,000, and the ARB shows about $1,500, I guess the market is pricing in very roughly a 75% chance of those tariffs coming into effect. I think if they don't, obviously there's going to be a huge normalization in the copper curve immediately, especially in the sort of cash to 3 months period. That will be
Thomas, even if they would you say that even if they do come in, the party ends at any rate? We're not going to see the same flow of copper going into the US, because what traders are trying to do here is to benefit ahead of the tariffs, right?
The question is how quickly things normalize, right? And the sort of the story has almost created its own reality in the sense that it's created distortions elsewhere, right? We saw a 20% drawdown in the Shanghai stock at the end of last week, and it was reported on Bloomberg that that was basically Chinese smelters taking material out of Shanghai warehouses to deliver into London metal exchange warehouses against their short positions. So it starts moving things around, and it takes a while for those things to move back again. And to the extent that there's already a relatively tight stock situation in Shanghai, you know, them taking stock out of there is really just stealing pizza to pay Paul. It's going to have to go back again because they actually need it. So I'm not convinced that if the tariffs go into effect, it's all going to go back to normal quickly. And in any case, it's going to even the certainty is going to cause dislocation, right? Even if eventually we go back to the situation that was sort of prevailing ex ante, the whole thing. And also don't forget there's still, you know, a relatively a relatively tight global market, even though we had those headlines last week that First Quantum is going to be able to export some of their stockpile concentrate from the beleaguered Cobre Panama mine. But at the same time, we've got artisanal miners are blockading Minmetals and Hudbay production capacity in South America. I mean, you know, it's a relatively finely balanced market and vulnerable to shocks, I would say, either way. And I would also say, yeah, go on, sorry.
No, go ahead.
All I was going to say is that we just had option expiry yesterday, and usually there's a fairly consistent vol granting program from the sort of Far Eastern trading community, where they try and basically collect some premium by granting calls and puts nearby, and it fairly consistently starts just around option expiry, so yesterday and today, and we've not seen any of these interests so far, which is unusual and worth noting, especially with copper at such high levels. So you get some fairly juicy premiums for selling a August 10,300 or 10,500 call here, relatively speaking.
And Thomas, thank you. In terms of the lending rules that the LME has put in, can you just run us through quickly and what you think the impact will be? I mean, the impact still has to be seen, but
well, very briefly. So historically, in order to stop people attempting to corner the market advertently or even inadvertently, it's not been possible to, or if you have held too much of the available stock, which means warrants, metal for delivery tomorrow and metal for delivery the next day, you'd be obliged to lend out your Tom Next position at a certain premium to the previous day's cash. So that rule's been around for a long time. What the LME have done very recently is extend that rule so that they look at your cumulative position from warrants, Tom, cash, all the way to the nearest third Wednesday. So sitting from today, that means the July third Wednesday. And if your the sum of all those positions is the available stock or more, then you're obliged to lend out the first Wednesday against the next third Wednesday. So in this case, to keep it concrete, July, August at level until your position is below the available stock. Now, July, August copper is nowhere near level. So what that tells us is no one holds such a dominant position at the moment. Now, on the margin, that's clearly, I think we would be tighter than we are if they didn't have that rule. But the fact that we're still tight tells us, you know, that the situation is quite severe. But I mean, you know, the prices tell you that in any case.
Speaking of well, LME, etc., what about the big trading houses? We've heard a lot about some moves in the news. I mean, any impact from there coming that's going to be that's being substantial on prices?
Well, I mean, in terms of there's sort of been some new kids on the block, right? We've had Mercuria make a big push into metals. This is widely reported. I think the reason the LME brought in this new lending rule actually was more about the aluminium market and the copper market, because as was widely reported, Mercuria had amassed a very large position in that aluminium, and indeed they were subject to a special measure that required them to lend out their June-July aluminium position at level until they got below the available stock. And really what the LME have done now is basically take what they'd applied to that situation and made it hold on the market as a whole. But yeah, certainly there's some new entrants who haven't been traditionally as large in metals as the likes of Trafigura and Glencore, and they're certainly making waves so far this year.
Thank you, Thomas. Priyanka, can I ask you to give us maybe your Asian view of things? We were sitting here in Europe pontificating and looking at things, but on the ground in Asia and China, how are you seeing this tightness? What is it causing it? What are you seeing that we're not being able to see, for instance?
Yeah, sure. I mean, I think the global story is very much, you know, about Section 232 and the copper flows into the US, you know, ahead of this tariff decision. But the reality is that I think, you know, with China being both the world's largest copper consumer and the world's largest copper smelter, you know, it plays a huge role in this global story. the demand in China is actually not weak. Even though the property sector has been subdued for quite a while now, copper demand in China is being held up quite well by infrastructure projects, power grid upgrades, and the electric vehicle sector. So you talked about this earlier, Bernard. Demand is largely driven by this energy transition story, and we're seeing that actually holding up quite well in China. Now, the other side of it is the fact that the smelter capacity has increased by 20 to 25% over the last 4 years. And obviously, all these smelters are now fighting for concentrate supply, which is already tight this year. We know that in 2025, the global concentrate market is in a 1.1 million ton deficit. So there's a scramble for concentrate supply by these Chinese smelters. They're actually producing more refined copper than they did, last year. So, we've seen reports where China's 2025 refined copper output is up 8% year on year. So there's obviously more refined copper production happening, and yet the stockpiles in China are very, very low. So that's a combination of domestic demand being strong, as well as some of this refined copper making its way to the US and to the LME, as Tom mentioned earlier. People are bringing some of that copper from Sheffield to LME against the current short positions that they're holding on the LME. So there's all of these different things that are playing out. But I think it's quite important to kind of remember that China demand is also a big part of the current tightness that we're seeing in the market.
Thank you. I think we'll start taking questions now. Please don't hesitate to send us questions. We've got a few minutes left. One of the questions we have here is, do we expect to see a price impact on the base metals markets following the European focus on defense spending? I'll start taking this unless Thomas and Priyanka have a view on this, but my take on it is that the spending is going to be substantial. Some of the NATO countries increasing their budgets to 5% of GDP, which is quite something, and the Germans increase spending. My take on it would be that I think for the main base metals, like let's say steel, aluminium, copper, it doesn't equate to a vast amount actually of extra demand. So if you look at steel, and it was a study that we had looked at in one of our prior webinars, was they're going to need to replace apparently like 1,000 tanks or so from the US. That equates to around 70,000 tons of steel. And I was saying on a market that's 2 billion tons, that's not a lot. Now, that's not to say that it's any steel. It's going to be specialist steel. So I think demand for specialist metals will be differently impacted from various other metals. Probably critical metals will be positively impacted on that, but I don't see a massive change in on the global price or the global demand equation when it comes to the the steels of that world, the copper or the aluminum. But again, especially things are different from the generic things. On that note, it doesn't seem we have other questions. Thanks a lot. We will have finished just on time. Thanks a lot for attending, and please don't hesitate to send us any questions that you may have. Have a good day. Thank you.